And in our top business story, as much as $101 billion could be spent annually across the globe towards making our cities smart. And this could become a reality in the next 5 to 10 years. Investments in smart city projects have been growing. Last year, Frost & Sullivan revealed that business opportunities worth $1.57 trillion would be created across different industries by 2020, thanks to various smart city initiatives. It also revealed that more than 26 cities, including Dubai and Masdar City, will attain the status of smart cities by 2025 and would also thereby have full integration of intelligent sensing technology. Along with it comes technologies such as smart grid and energy storage, smart meters, wireless sensor networks, open platforms, high-speed broadband and cloud computing. Recently, another report by Navigant Research, which examines the strategy and execution of 16 leading smart city suppliers, gave an estimate showing that at least 101 billion dirhams would be spent every year on global smart city initiatives. According to the report, as the supplier ecosystem for smart cities continues to expand, established suppliers are moving into the market from the energy, transport, buildings and government sectors, while startups are addressing a range of emerging opportunities. Currently, $8.8 billion is spent annually by the global smart city technology markets. And internet spending in the Middle East is booming, with the GCC countries expecting a 40% growth in e-commerce by 2020. That's according to officials from global growth consulting firm Frost & Sullivan. The insights were revealed at a recent presentation by the firm at the Summit for Growth, Innovation and Leadership, which organized by Frost & Sullivan on Monday in Dubai. According to them, the potential of e-commerce in the Gulf is very high, and by 2020, e-commerce sales across GCC countries is expected to touch $41.5 billion, which will be one of the highest growth across this industry worldwide. The UAE is expected to be a key market for e-commerce, with a total market share of 53% across the GCC countries, followed by Saudi Arabia at 14%, Oman at 12% and Qatar at 10%. The UAE is expected to lead this category because it has the highest computer ownership in the Middle East with 76% market share, as well as the highest in internet penetration at 78%, and highest per capita online retail spending on par with US and EU. In general, e-commerce is expected to double in value by 2020 in the Middle East and North Africa, contributing to about 5% of GDP. Currently, it represents about 2% of GDP. E-commerce in MENA region is expected to grow from $95 billion in 2013 to $200 billion by the year 2020. Profit growth at banks in the UAE is expected to slip to 5.5 to 6% in 2015 as macroeconomic challenges and the absence of big improvements in asset quality strangle lenders' earnings. The forecast came from Standard & Poor's on Monday in a recently released report from the ratings agency. According to statistics, UAE lenders have enjoyed bumper earnings growth in recent quarters, aided by buoyant economic conditions locally, strong credit growth and the reduction in levels of cash set aside to cover bad debts. In the final quarter of last year, the top 8 UAE banks by assets all reported year-on-year net profit growth of between 13% and 82%, building on successive quarters of strong growth earlier in the year. However, lower oil prices are expected to feed through the reduced economic growth this year, which will reduce demand for new lending from companies and in some cases will increase default levels on existing debts. This should trim sector-wide profit growth this year to 5 to 6% from 22% in 2014, with return on average assets dropping by 20 to 30 basis points from the 1.9% registered in the first 9 months of 2014. Despite the subdued earnings growth compared with recent increases, S&P stated that UAE banks are unlikely to face a similar situation to the turn of the decade due to the strengthened position of government companies as well as less debt at the developer level. Construction projects valued at $67.6 billion were completed in the Gulf region during 2014, according to a new research conducted by Ventures ME. The study also forecasts that the pipeline of projects will continue to grow this year, with development schemes worth $72 billion, up 6.5%, to be completed and $103 billion to be awarded across the year. The study said that 2014 was another strong year for the construction market, with residential construction rising by 41.5%, commercial by 16.97%, and educational construction by 10.6%. It added that the top markets across all sectors, bar retail, were Saudi Arabia and the UAE, with Qatar ranking top with completed retail projects worth $362 million. The value of the GCC interior contracting and fit-out market in 2014 was $7.35 billion, with the research showing that Saudi Arabia and the UAE had the highest market share. Saudi Arabia was the highest ranking market with a 43% share, followed by the UAE, which represents a 31% market share. Looking ahead to 2015 projects, the Ventures ME report highlighted that figures across both the building construction and interiors markets are both set to increase further. $72 billion worth of completed projects and $103 billion worth of awarded projects are forecast over the next 12 months, with the interiors market also likely to grow by 9% to $7.35 billion.